Hello, this is Professor Capko, and this is the next video in my Business and Accounting series. Today, I'm going to introduce you to the four basic financial statements. These statements, in one form or another, are used by businesses to report to their owners and others how the business is performing. I'll tell you what those four financial statements are just as soon as you hit the like button. It really helps me to get this information out to others who are trying to learn business, accounting, and finance. Thank you. Well, without further ado, those four basic financial statements are the balance sheet, the income statement, the statement of cash flows, and the statement of shareholders' equity. Let's dive in. So the first one I want to talk about is the balance sheet. There are three main parts to the typical balance sheet. There's assets, liabilities, and owner's equity. I'd like to describe the balance sheet as a photograph. It gives a picture of how a particular company is doing at a specific date, usually the end of a period, such as the end of the year or the end of a quarter. The balance sheet shows the assets, which are things that the company owns, and liabilities, which is money the business owes to others, and owner's equity, which is sometimes called net worth. The next statement is the income statement. I do want to point out the balance sheet must balance, that's hence its name. But the next one we're going to talk about is the income statement. I like to describe this one as a movie. It shows revenues and expenses over a particular period of time, such as a year. The revenue is generated through sales or operations, so that's money in. And then expenses are subtracted. And the remaining balance is either a profit, if it is positive, or if the expenses exceed the revenue, then it's going to be a loss and a negative number. The next basic financial statement that I want to discuss is the statement of cash flows. This one is exactly as it is named. It shows the amount of cash flowing through the organization during a specified time period, maybe like a year. We will discuss in a later video why cash flow might differ from the revenue and expenses found in the income statement, because it often does. And the last of the four basic financial statements is the statement of shareholders' equity. This is sometimes known as the statement of retained earnings. So it could be retained earnings. This statement shows the changes in equity during a particular time period. It's going to show whether or not the value of the company is going up or down with regard to retained earnings. I will do a deeper dive into each of these basic financial statements in a future video. But for now, you have been introduced to the four basic financial statements: the balance sheet, the income statement, the statement of shareholders' equity, and the statement of cash flows. Let me know down in the comments if you think I missed something. Also, make sure you subscribe and hit the notifications bell so you'll be alerted to future videos on these topics. If you're interested in private instruction on these topics, I offer that service. Information on how to set that up is in the description down below. Thank you, and until next time, keep your grade alive and subscribe. Until then, this is Professor Capko.